Investor clients often ask me, what kind of loan is the right loan for me? And there is not one answer that's correct for everybody. Some loans are good for certain people. Some other loans are good for certain other people. So today I'm going to be talking about two different types of loans that are very widely used within investors when they buy their investment property. One of these loans is called the full docs loan. So a lot of people get scared when they hear full docs. But full docs basically means that you're going to have to provide personal income documentation to prove that you have the capacity to pay whatever debt you already have, plus the new debt you're going to acquire. Now, you're still going to take in consideration that this investment property is going to produce a certain amount of income as well, but you have to have a bunch of documents that you can provide to the lender so that they can really analyze your capacity personally to cover the payment and the obligation for that new loan. Now there is this other loan. It's called the DSCR. It doesn't mean no docs. It just means a lower requirement of personal documents. So with a DSCR loan, which stands for Debt Service Coverage Ratio loan, what's most important for the lender is to see how the property itself would perform. So the property per se is the one qualifying for the loan, not you and the property. But in any case, they're going to be asking for personal information. It's just that a lender that provides a DSCR loan product is not going to be asking you for personal tax returns. They're going to be asking you for your credit worthiness, basically reflected on your credit report or your credit score, because they want to know that they're lending money to somebody who's responsible and who can cover the debt and who has a history of paying their debts responsibly. So I'm going to be talking about specific pros and cons on each type of loan, the DSCR and also the full docs. To make it easier to understand, I'm going to point out what the main advantages and disadvantages are on each type of loans. And I'm going to start with the DSCR loan. The main advantages are that you don't have to provide personal verification of your income like W-2s or tax returns or pay stubs and none of that. Also, if you're self-employed or if you have complex finances, several of my clients not only have investment properties, but they have businesses, they have a lot of things going on. So their tax returns are very complex. A DSCR loan won't even ask for those. So that's a good advantage of these. The approvals are usually faster, and therefore the closings are usually faster because they don't require that much paperwork. And these type of loans is going to be looking at the performance of the property instead of the finances of the borrower. Of course, there are disadvantages of this type of loan as well. One of them is that they usually have a higher interest rate than the traditional loans or full docs loans. And they require that the property has a stronger rental income. The DSCR is a ratio, which basically means if you make a certain amount of money in income from that property, and then you spend the same amount of money on covering your debt service and basic expenses like insurance, taxes, and HOA, then if it was the same amount of income versus expenses, you would have a DSCR of 1. So usually this type of loan would require a little higher, like between 1 and 1.25. 1.25 means that you would earn 1.25 times what you really will spend. That's the basic definition. We can get more technical on that, but that gives you an idea. So let's say you rent a property for $1,000, but by the time you pay the mortgage, which already includes taxes insurance, and then you add whatever other obligations like HOA or POA, that's like condominium charges. And if you end up spending $1,000, then you have a DSCR of 1. So if you want to qualify with a DSCR of 125, that means you still spend $1,000 on all those expenses, but you're collecting rent of $1,250. That's basically what that means. So it's a stronger requirement with this type of loan. But those deals are there. It's hard to find. They're hard to find, but you can find them. And they require a larger down payment, usually at least 20%, but you will get better rates or better terms if you have a 25% down payment, or if you're refinancing, most likely they're going to require that you only leverage 75% or 70% of the value of the property. So that's a larger requirement because it's just the property that's qualifying. And then in certain markets, there is limited availability or there are restricted terms for those markets. Now, I'm going to be talking about the advantages and disadvantages of a full doc loan. The main advantages of a full docs loan is that you are likely to get a lower interest rate and better terms. They have more loan options because now you could qualify for a conventional loan or even some of the guaranteed loans such as FHA and that type of loans, and that allows you to come up with a lower down payment. Still, it's not going to be as low as if you were buying a principal residence because it's still an investment property, so you have to have some skin in the game regardless. Down payment could be 15 to 20%. And these type of loans can be applied for any broker, any bank, whereas the DSCR loans are only for certain lenders that are, we call them commercial lenders that do that type of loans. Now, there are disadvantages of the full docs loan is that it requires extensive documentation. You're going to have to provide income taxes, assets, debts, employment information, just like if you were buying a principal residence. And for those of you that have done it, you understand there's a lot of requirements, a lot of paperwork. Now, the approval process is also slower. And if you're self-employed or you have inconsistent income, it's going to be harder for you to get this type of loan. And the debt to income ratio, that means how much income you have versus how much obligations of debt you have, are bound to certain guidelines, and they are very strict on this type of loan. Another disadvantage is that you can only do a certain amount of purchases using this product. The bank or the lender will often tell you, well, you could do up to X amount of properties using these loans, and after that, you can't issue any more investment property loans using full docs. And some of these lenders don't even offer DSCR. So if you have a favorite lender and you acquire a certain amount of properties using them, then you can't buy any more up until a certain point. Usually it could be 7 properties, it could be 10 properties, but there will be a limit on how many properties you can buy using full docs loan. And there is also a disadvantage when it comes to investors that are getting to that professional level and they want to title their properties under LLCs. That's a common thing on investment properties, but if you do full docs, it's hard to do under LLCs unless all your personal information is together with the LLC, which kind of defeats the purpose of titling property under LLCs. It can't be done, it's not impossible, but it's a little difficult and it makes it a little pointless to do it under LLCs. In the description below, there will be a little summary that's going to tell you the basic differences between DSCR loans and full docs loans. But if you do have a question about any other type of loan, or if you have any question that's related to real estate, either for principal residence, investment property, or commercial property, feel free to leave a comment. And I just want to make sure that people have an idea of what the difference is between one type of loan and the other, so that they have a good understanding on how to approach their next acquisition of real estate. If you know of anyone that could use this information, please feel free to share this video, and I would really appreciate it if you subscribe and like the video. That helps me reach more people, and I'll be able to answer more questions that come from the people that see those videos. And remember, your financial security does not have to be bound by borders. So thank you very much.